Prashant Jain, Executive Director and Chief Investment Officer with HDFC Mutual Funds. Prashant, morning. What a delight to have you back on ET Now. Thank you for joining us. Let me first start with your note, which is in my hand. It is titled as It's Tomorrow That Matters. And the good news here is that at HDFC, your opinion is that at these levels, Indian markets are pricing in all the bad news. Why is that?
I think, the P's sum it up all, and if you look at last 4 years, the P's have come off significantly, all the way from 22, 23 times to maybe 12 times, 13 times, 13 and a half times. And when interest rates are sitting at a peak, I think this means that the earnings yield is now virtually the same as the bond yields. And I don't think in a growing economy like India, it is possible for earnings yields to be higher than bond yields for too long. And that's why one feels that yes, there have been issues with the local economy, there have been issues outside India, but markets are forward looking and markets do tend to price in these things, and one just feels that these things have got priced enough. But as you know, we find it extremely hard to time the market shorter term. So all we are saying is that from a medium to long term perspective, markets are attractively valued.
Prashant, what about the credit policy today? What is it that you're expecting from the central bank? Can we see a more than 25 bits cut today?
See, I would not like to speculate on this. It's very hard. But I think one thing is clear is that interest rates over time should move down. And the big fall in crude prices of almost $25-30, I think will do a lot of good to the fiscal deficit. And if government does something on the diesel prices front, it will be very good. But a $25-30 fall has curtailed fiscal deficit very sharply if oil remains at these levels. And I think it will make it easier for lower interest rates to prevail if fiscal deficit is also fixed.
Prashant, out of the 4 factors which are dragging Indian markets down, factor number 1 is Europe, second is fiscal deficit, third is currency, and fourth is inflation. Your view at HDFC is that 2 out of 3 domestic factors in the next 1 year will improve. Why is that?
See, I think Europe, I would not agree to that Europe is impacting the Indian economy. It can impact stock markets for a few weeks here or there, but the German markets have not fallen since the Greek crisis broke out. Indian markets have underperformed the German markets. So how do you explain that? So I think, yes, news headlines occupy, lots of them are occupied by Europe, but I don't think Greece has a material impact on Indian economy per se. It could impact short-term returns on the equity markets. And anyway, Greece has, at least for the time being, it appears that it has got resolved. I think inflation in India was an issue, and even today probably to some extent it is an issue. But I think with the very sharp fall in oil prices, both fiscal deficit and this should get addressed to a large extent. And the key assumption is that oil remains sub $100, which one is optimistic because the largest producer of oil is publicly saying that they are comfortable with oil at $100. As far as interest rates are concerned and currency is concerned, I think currency over time should react back. This is my very personal opinion, because in about few weeks from today you will start seeing the benefit in balance of payments of the sharp fall in oil prices. There is a few weeks lag when you contract and when the prevailing oil prices when they flow through. And I think rupee over time should appreciate from these levels, but currencies are hard to forecast, but this is just my gut feeling.
Prashant, I understand you don't want to speculate on what the central bank action is, but what do you think the markets have priced in? Because the kind of run-up that we've seen in the last 2 weeks has been pretty phenomenal in equities, with no fundamentals actually improving on ground.
No, but I think that is not markets are forward-looking and markets do tend to price in things, and I think markets will price in as we go along lower interest rates. Whether interest rates are cut this month or after 3 months, whether by 25 basis or 50 basis, I think is quite difficult to forecast. But if you look at the 10-year bond yields, and I think they have moved down pretty decently. So yes, I don't know what exactly markets are pricing in, but my guess is that 1 year from today, 6 months from today, interest rates in India will be reasonably lower. They could be even meaningfully lower. And I think that is what is more important than what exactly happens today.
Prashant, if I look at your current portfolio construction, you are bullish on banks, and within banks, it's PSU banks where you're bullish on. So you're not worried about NPA quality, book quality?
No, I think one is there is clearly a concern. It would be wrong to say one is not worried. But I think, as I said earlier, the markets do price in these things. And it is my opinion that markets are being fairly conservative, being fairly pessimistic on the asset quality of these banks. And when we are sitting at peak interest rates with crude at sub $100, with fiscal side improving, I think going forward as interest rates are lowered and as banks pass on these benefits to the borrowers, the NPA problems should get resolved over time.
Telecom is making a comeback in some of your key portfolios. Again, do you think at these levels telecom stocks are pricing in all the bad news?
I think we have been, we are, at least I am personally quite confused about the telecom sector, and we are close to market levels. And yes, the regulatory clarity should emerge in the next few months, but we cannot ignore the fact that from a longer term perspective, this sector is becoming a mature sector. The mobile tele density can go up only so much and not beyond that. But I don't have a very clear-cut view on this sector at this point of time.
What about large cap IT, Infosys, TCS? We have a fairly decent exposure that as well. But given the kind of management commentary we've got from Infosys, do you worry that Indian IT industry in the near term, in the medium term, could experience some headwinds?
Very hard for me to say something which has not already been commented upon by the managements. We rely upon their commentary to a large extent in forming our views on this. If you look at longer term, the IT space, the growth rates have been coming down, and I think that is quite logical. But companies do remain confident that over longer periods there are still growth opportunities, and they should be able to grow at a healthy rate. But these rates should nowhere be close to what we have seen over the, let's say, 5 years back or 10 years back. So I think this remains a very competitive sector globally for India. It remains a growing sector, and I think the multiples are either slightly undervalued or fairly valued to my mind.
Prashant, what about cyclicals like cement, which have seen a good traction in the last few days? Would you advise investors to switch to cyclicals like cement with an adequate hedge?
See, again, I'm quite. I don't have a very clear view on cement at this point of time. The large cap cement stocks are trading at close to one times replacement or slightly ahead of replacement values. So I would not say there is any excess there, but I don't see a great value there either.
So Prashant, your big call for FY13 and beyond FY13 is that consumer stocks are expensive. It's time to sell consumer names. It's time to log out of consumer names, and it's time to revisit investment-oriented businesses. Why is that?
See, if you look at our portfolios, we have a fairly balanced view of the markets at this point of time. We have consumers, we have telecom, we have IT near market weight, we are slightly overweight on banks. So I'm not saying that consumers are so expensive that you cannot make a reasonable returns on them. They are very high quality businesses, very sustainable businesses. But yes, if interest rates have to go down, if risk appetite has to come back, and I think the consumer at some point of time should at least slow down somewhat. Then from a returns perspective, probably you can make slightly more returns elsewhere than in this space. So I think that would be a more accurate view of what the thought process is.
So what's been your portfolio strategy of late? Are you buying banks on every decline and selling consumers on every uptick?
See, I would not like to get into specific portfolio actions, but as I mentioned to you, we are maintaining a fairly balanced view of the markets. But I think if interest rates do go lower, as I think they will, then interest sensitives should outperform the non-interest sensitives.
Prashant, what's happening at liquidity level? One is getting a sense that currently mutual funds are getting a lot of redemptions and flows have dried up. Is that true for HDFC as well?
I don't think so. I think nothing material has changed. In fact, last month I think the industry got some net inflows in the equity funds. And I think we have to also keep in mind that when markets, at any point of time, whenever markets show a sharp spike up, there is a round of investors who remove some amount of money. But I think net things appear to be okay to my mind.
What about the currency, Prashant? Can we see further strength actually kick in now that the dollar has somewhat eased off with what has transpired out of Greece overnight?
So I think currencies are very hard to forecast, harder to forecast to my mind than even equity markets. But the two key variables here to my mind are oil prices and gold import volumes. And if you look at the gold import volumes over last 8-10 years, they have gone up massively. So maybe just almost 10% of household savings are being invested in gold right now, were invested in gold last year. And that's a very high number. And I think that number should come down if gold prices stabilize. I am not an expert on gold, but if you look at the real prices of gold over many decades, they are today at a level from where they have not yielded. They are close to historic high levels, and from which levels in the past they have not yielded any returns. So if gold were to stabilize or this momentum were to come off, I think with higher interest rates in India, money could move away from gold. This is just a view. I am not saying gold is peaking out. Very hard to forecast that. If gold volumes drop off, and last 5-6 months data is indeed suggesting that gold volumes into India are moderating sharply. If crude prices have moderated 20-30%, last year's average was $115. Right now we are at $95. So I think these have been the two key pressure points on current account, and you can explain the entire deterioration in current account on account of these two. And I think if both these factors are getting addressed, then I think over time currency should move up to my mind.
So from a 3-year perspective, or not even 3 year, from a 5-year perspective, do you think Indian markets could give a double-digit CAGR return?
So I think clearly, that would be my opinion, because the longer term trend growth in India is about 13, 14, 15, 16%. And the P's, whenever they are below average, you will get that extra returns from re-rating. And I think that's a fair view to my mind, that over the medium to long periods of time, one should not just make money on earnings growth, but there is reasonable room for P's to move up. So yes, that is true what you are saying. I would agree with that.
What is the biggest challenge for HDFC Mutual Fund, the environment or size? Because now you're managing closely $10 billion in equities. The size is growing on a daily basis. Can you find fresh ideas to invest at these levels, at such a size?
And that's what the endeavor is, and that is what we have done so far. And I think we continue to stay focused on trying to deliver returns better than the markets. But it's one way to look at size in absolute terms, and the other way to look at size is in percentage terms of the market. And if you look at that, I think we are still a very small part of the market. So I don't think we are close to being crowded out of the market.
If I give you 60 seconds to make a sales pitch, Prashant, if I give you 60 seconds to make a sales pitch to a retail client, how will you sell HDFC Mutual Fund? How are you planning to differentiate?
I think first I would say that invest in Indian equities. That's the key. And we have a good track record, and we have a very good team. We have a very experienced team and a very stable team, and we have a track record of doing better than the markets across cycles, across products. So bulk of the work will be done by Indian equities, and we hope to give something extra over and above that.
That is part of your perspective, Prashant. When I asked you that how are you planning to differentiate, I wanted to understand your investment philosophy, your portfolio strategy.
I think we invest in quality. There are not too many fund houses who can say that across time periods, across products, they have done better in the market. I think we have done, and we are proud about it, and we hope to sustain it. I think what this is a result of is focus on quality, not getting carried away by pure momentum, and investing in businesses which one we understand, which are of reasonable quality and which are not overvalued, remaining diversified, and invest and not succumbing to pressure when the performance is not good, and sticking to your beliefs. And so far this has worked for us, and I see no reason why going forward it should not continue to work for us.